Welcome everyone to today's program. I am Laura Fetter, Program Director for the Wilbur F. Breslin Center for Real Estate Studies at the School of Law at Hofstra, and I would like to welcome you to our 13th annual conference, co-hosted by the Breslin Center and the Frank G. Zarb School of Business at Hofstra. On behalf of myself, the center, and Ashira Ostrow, Executive Director of the Breslin Center, we are delighted to present today's topic, Emerging Technologies in Real Estate and Finance. Our speakers today are among the most well-renowned members of the real estate and financial communities, and they are here to offer a national and international perspective on emerging technologies and implications for real estate and finance. Before we begin, I would like to thank our outstanding conference co-directors, Professors Ihsan Nikbat and Andrew Spieler. They have done a tremendous job organizing our panel and this entire conference. So thank you so much. I will now turn the program over to Professor Nikbat. And just a reminder, if everyone could just please stay muted, we will have plenty of time for Q&A after the presentations. Thank you so much.
Thank you, Laura. We have a number of participants from outside Hofstra, including overseas. It is my honor to introduce our Dean, Dr. Janet Lanahan, the Walter H. Bud Miller Distinguished Professor, and the incoming interim provost at Hofstra effective August 2021. Dr. Lanahan has been our dean since January 2019. During her tenure, the Zarb developed several new degree programs which respond to emerging business and workforce trends. At the graduate level, as an example, she led the development of an interdisciplinary theme-focused EMBA, as well as new programs in cybersecurity using the state-of-the-art technology in the industry. At the undergrad, she led the revision of the BBA to better align with market demand. A renowned expert in human resource management, Dr. Lanahan is regularly quoted in local and national media on workplace issues, most recently about how businesses are managing workplace changes related to COVID-19. An accomplished scholar, Dr. Lanahan has presented her research at international, national, and regional conferences and has published in a variety of academic journals. She currently serves on a number of advisory boards, including the United Way of Long Island, the EFMD Global Network, and the Long Island Software and Technology Network. Dr. Lanahan has twice been recognized by a student as a Hofstra University Teacher of the Year, 2016 and 2013. Dr. Lanahan received her doctorate degree from Pace University and MBA from the Zarb School and undergrad from Adelphi University. I want to thank Dean Lanahan for all the support, encouragement she always gives in promoting research and conferences. Now allow me to turn it over to Dean Lanahan. Janet?
Thank you, Ehsan, very much. And let me join in welcoming all of you to our event this afternoon. Of course, we are disappointed to not be meeting in person on our beautiful campus. But one thing this year has proven is we certainly can have great conversations and learning experiences thanks to the power of Zoom. But we certainly hope that next year you'll all be on our campus enjoying the beautiful tulips this time of year that are blooming. You know, the Wilbur F. Breslin Center for Real Estate Studies is an important part of our university and serves as a tremendous platform for thought leaders to share insights on current topics. And certainly today's discussion on emerging technologies is evident of that commitment. And as Laura said, events like today take significant amount of work. And I want to thank the conference directors for their tireless efforts. Right from the Frank G. Zarb School of Business, Dr. Andrew Spieler and Dr. Ihsan Nikbat, and of course, Professor Astrow from the Maurice A. Dean School of Law. Each of them are distinguished professors and truly embody that designation in all they do.
In the interest of time, we're going to move right through the program. Each speaker will have about 15 minutes. We'll defer Q&A to the end. And unfortunately, I won't be able to give the full bios. You could read them online. They're wonderful speakers. I will first introduce Hugo Benedetti, who is zooming in all the way from Chile. And that is one of the advantages of Zoom and technologies, that we can bring in wonderful guest speakers. Hugo is a friend, a colleague, a co-author, a good friend to Hofstra, and very accomplished expert in the area of blockchain, cryptocurrencies. He's been quoted by Wall Street Journal, Economist, Bloomberg, you name it. And with that, I'm going to turn it right over to Hugo to enter and start his presentation. Thank you so much.
Well, thank you so much, Andrew, and thank you everyone at Hofstra for the invitation to talk about this exciting topic, at least for me, which is blockchain. And I'll be talking today of how we can apply blockchain to real estate. I'll be talking about some work that I did as part of a team while working at the Digital Currency Initiative at MIT. And this was work done jointly with the Fidelity Center for Applied Technologies. So this is the team. This was a wonderful team. And I know a lot of you are students at Hofstra now. So I'm gonna quickly go over where these students are. So Manasi is now the business developer at Nebulous and Skynet, which is one of the largest blockchain projects out there now. Julie is now leading the Central Bank Digital Currency Initiative for the Federal Reserve of Boston, along with MIT. Kenta is building a new fintech bank in Asia, and Seb is still a consultant in the blockchain industry. This is all to say that this area is ripe for business. It's ripe for students that want to enter the business, not necessarily from the technical standpoint, but from the business perspective of how can we apply this new technology into current business situations. And this is what we did during this research. We just took this broad question as how can we use this technology in commercial real estate? That's the broad question. So I'll be talking about a few things. First, I'll talk about the potential benefits of blockchain applications. And here, to be clear, I'm not going to say that blockchain is the best solution to some of these problems, but they are a solution, and we'll see how these solutions can link together to build something bigger. I'll talk about the 3 domains of blockchain applications for real estate, regarding security tokenization, how blockchain can be applied to the investment value chain, and lastly, tokenization of assets. I'll quickly go through some examples, and I'll end discussing a little bit of valuation of tokenized assets. So just briefly, 3 key definitions. First, a token is going to be a blockchain-based representation of something. Here, I'll be talking about asset and securities, but it could be a representation about anything. And we have 2 broad types. First, we have a tokenized security, where the token represents something that exists independent of the blockchain. So it becomes blockchain embedded. There's a digital copy of the instrument on the blockchain. And by doing this, this traditional asset will receive additional features. And some of these can be positive, some will be negative, but it will keep all of its physical properties, but it will add another layer of features. And think about this about something like a depository receipt, where you have a receipt that represents something that is kept by someone else, or it's outside of the domain of the blockchain. On the other hand, we have security tokens, where the token itself represents the security that is not outside of the blockchain. It only resides within the blockchain. So this is something that's completely digital, and we call it blockchain native. And these instruments, these blockchain native securities, have all the features possible to the blockchain, but none of the features that we would see in the physical world. And this is going to set apart and bring up a big set of differences between digitally native and digital representation of assets. All right, so there's not a typo on the title, and the reason is that this project started as looking for applications to commercial real estate. But as we move forward, we realized that all of the things that we were finding as potential solutions were applicable to real estate in general. Now, the project was funded by Fidelity, so we had to keep the title, but just to make sure that everyone understands that this is a broader application than just commercial real estate. So some of these solutions or some of these benefits you already know. I'll go quickly through them so we can have more time for discussions. But they go along the line to provide access to securities to unserved investors. So by reducing the price of issuance and providing greater access or being able to reach a global audience, it could provide access to more investors. The same features would allow to increase liquidity or to allow faster and cheaper trading across the world. Now, when we look at blockchains and cryptocurrencies as means of payment, this could also provide some streamlining of payments and more easy flow of money across the value chain. We could also use blockchain as a backbone for management and administration of properties. And if we are able to embed additional information, as Jeff mentioned, by IoT, by including devices that will provide information about the asset itself. So for instance, think about people flow, usage of parking lot, fire alarms that went off. All that information can be included not only on a blockchain, but be directly related to the asset that we're valuing. So it would not only have the physical properties, but it will also have attached all the information that that asset has generated across time. And that is valuable information for investors. Also, blockchain technology could provide investors with the ability to customize their portfolios in a cheaper way by allowing them to trade smaller parts of their investments. And this also relates to granularity, because if you reduce the cost of issuance, you will be able not to invest in the entire building, but you could think about investing in specific units within the building. All these features can create demand from new users or from new business segments that so far have not been part of this investment area. And then the list goes on and on and on, because there is so much we still don't know about all the applications that could be included within blockchain. Now, all of these benefits can be thought about in three big domains. The first of all would be tokenized securities, where we're taking existing securities for real estate, and then we're including them on a blockchain. We have key players like issuers or the token trading platforms or exchanges, and we also have current traditional players as equity investors, step investors, and investors in securities that are derived from these initial securities. We can also apply blockchain through the investment value chain, like I mentioned, using it as a backbone for traditional processes. So back office record keeping and things like that. And lastly, we can think about also applying blockchain to the asset itself. So instead of tokenizing a security that represents an asset, we can tokenize the asset itself, where each asset has its own token or its own representation within the blockchain. Now, I'll discuss the first two potential benefits. When we talk about access and liquidity, we're basically thinking about providing a new pool of investors, reaching lower cost of financing, lower transaction costs, faster settlement, out-of-compliant smart contracts, more efficient processes, and providing additional data to provide more transparency. And we have a narrative that it's present in the market, but we also have found some caveats to that narrative. So the first one is fractionalization, this assumption that market participants would like to purchase a part of a building, or will be looking at being able to customize their portfolio. But as Jeff mentioned, technology has to be linked to the user value, and we don't know if there is demand from that feature in current investors. We don't know if there are features that or investors that would want to invest in apartment 113 of the building instead of purchasing a part and a share in the building itself. Regarding this global reach or larger pool of investors, it's true that some investors might want to invest in properties across the globe, but issuers have this worry about how regulation is going to affect them. And issuers will be very concerned about providing securities that are not compliant with local regulations. We also talk about this illiquidity discount, that because these assets are illiquid, then by providing liquidity, we'll be able to capture some of these premium. But then on the other side, there are investors that choose this asset class because it's illiquid and because it has this these properties that will not fluctuate on price through the market. So again, we don't know if there is a demand for these specific feature. And there's also this notion of asymmetric information, where there is not a single source of truth about the information of an asset. So if we could provide that on a blockchain, well, more people will have access to this information. Now, the problem lies with the current or the incumbent companies that already have access to this information. So large investors are able to withdraw and to capture information about a property better than a small investor. And this allows them to reach a premium. So they're able to figure out which are the best spots to place a mini market, for instance, because they can watch car flow around the area, while a local investor might not be able to get that information. So this moat that is built upon being able to access information, if you gather that information and put it on a blockchain, and you leave everyone to be able to access that information, well, it's going to destroy value for the people that are already in place. So we don't know how this is going to affect the ecosystem and how this can stop adoption. And here's an example of one of the tokenized assets that we saw on the market. This was a campaign by Indiegogo on Aspen Resort, where there was an SPV that was created, and shares of the SPV were tokenized, and that token was traded, sort of a crowdfunding campaign. But the problem is that this was offered only to accredited investors with a minimum investment of $10,000. So some of the premises that were pushed forward in terms of gaining access to more retail investors, that was not true, at least with this case. So I'll go very quickly through this, so I know we don't have much time. And I'm going to discuss a little bit about this backbone of using blockchain as a repository for information. In general, we have this paper-based track of information that's not only about contracts, but also it's about adjustments, modifications to the contracts, and payments, which in the US are still 35% done by checks through the mail. So if we had this on a blockchain, well, not only would we have this immutable source of truth for the original contracts, but we could also have that record and all the information that the property has created through time be linked to the blockchain and be linked to the asset, being able to provide additional value. As Jeff mentioned, if we link IoT devices, then we can create additional information and we can continually store this information on a blockchain. And obviously we can perform payments directly on the blockchain. So final thoughts, well, this asset tokenization or the representation on a blockchain of an asset provides improvement over some current technologies like basic digitalization, but value enhancements come from the additional infrastructure that can be built around them. So if we think about building things around tokens, well, we're thinking about markets, RegTech, advising in general. We can build things through them. So through tokenized securities, we can create new financial instruments. We can create trenching of flows payment, for instance. And we can build new things inside of them. So we are able to monetize specific properties or features of the asset itself. So as we develop additional layers of information, additional layers of services, and additional protocols around blockchain, we'll have new ecosystems that will enhance these value chains as we come up with better uses of information and new uses for that information. So full adoption is not required for any domain. Any standalone solution provides certain benefits, but as adoption increases, so do these synergies and complementarities. So I'm thinking I'm almost out of time. So if you want more information about this report, it's posted in a lot of web pages. Just Google CRE tokenization and you'll find it. Well, that's it for me. Thank you, Andrew.
Wonderful. Thank you so much, Hugo. That was a great presentation. We're going to shift over to Josh Harris. And Josh is a veteran of this conference, having presented before. So very glad to have him. Previously, I think when you were here, you were as the clinical director for the real estate studies at NYU, the Shack Center. And now you're back in commercial life. We have a lot of mutual friends and interests, and I know you have a lot of interesting things to talk about. So I'm going to turn it right over to you, Josh. Thank you.
All right. Andrew, thank you so much. So I've made the option to go sans slides, and part of working for one of these large corporate operations, when I go out to speak in one of these public venues, if I go with slides, I have to get various parts of messages approved. But if I go without, I can kind of just speak my mind. As a professor and friend, Ishan, as we become co-authors in our time since we've last, I think, did one of these conferences, working actually on a chapter in a book regarding blockchain and real estate. And you know, this concept of emerging tech and real estate is, I think, something that you would be shocked as somebody to know how much parts of the development world, or at least in my company, and I think a lot of other of our competitors, the brokers, are actually spending. So if you're a student in the audience, be it on the legal side or the real estate, the business school side, I mean, this isn't just some kind of a fun topic that, you know, we pick for a day for a conference. I mean, this literally is taking up the time, and positions are being created to tackle these questions. I mean, literally full-time jobs. In fact, we had a director, a great friend of mine was our director of innovation here at Skanska, and as upwardly mobile people do, he actually left for he got a better job per se, and now we'll have to replace him. I mean, it's been a really big uptake. The other big area is sustainability, which also has a very high linking to technology. In fact, we've used the phrase sustain-ovation, sort of putting together sustainability and innovation. So if you're interested in that world, I mean, just know that these things are not looked at exclusively. And I think the biggest thing I want to say about technology, when you think about it with regards to real estate, and this is a very deep time philosophical thing. I know Andrew, Ishan, anybody who's ever done research in real estate can really appreciate this, because I think it's actually helped make people's careers. In fact, one of our mutual friends is my dissertation advisor, Randy Anderson, who's sort of the academic, who's also now back in industry full time, like I am. You know, he told me early on, like, one of the ways he kind of made a career of publishing papers was he took concepts that were being published and researched in the banking industry and realized nobody ever did it with REITs, with real estate investment trust stocks, right? So he sort of, you know, got a really strong record of publications by, you know, basically porting over ideas and adapting them into the real estate field. And, you know, I mean, it sounds like some random comment, but the more I realize, that's actually been how real estate's always gone. And real estate, if I had to describe this, and I mean this not to be totally derogatory, just to be honest, real estate is an industry that runs about 20 to 30 years behind finance, or even sometimes mainline business. It's just it's harder to get. I think although the law students or anybody who's in the law field who gets involved in real estate transactions, you guys know this instantly. I mean, like, the process of closing real estate still involves maybe a sit-down meeting or, you know, exchange. I mean, we're barely getting into digital signatures. It still involves often clerks that are running actual pieces of paper down to a courthouse, and where things are literally being scanned by a camera and then entered. In fact, most deed records are not digitized at all. In fact, they're usually very sketchy cameras. And then there's corrected deeds because someone can't read a signature, or someone literally scribbled in a date wrong. And that's still today. That's still 2021. A lot of these deals are going to be closed that way. So what does that mean? That means there's a ton of opportunity here, right? I mean, like, does it mean that real estate will always be behind the times? No, it's just that it's gonna lag. Now, I see Isan's got a great background there with, looks like a Bloomberg terminal, right? Well, one of the things about real estate that it frankly, maybe it'll get there. I don't know, but like, I mean, with stocks and other digital, and sort of financial assets, it's really easy to create tickers and QSIP numbers, key them into a terminal, and you can get all the research, trade away, tag it, right? I mean, so moving from what's there to a blockchain per se, it's a lot easier to imagine. When you talk about real estate, you have to create a whole new ecosystem. And I think that's one of the biggest areas that, like I said, and I'm sure IBM and other companies, I'm sure they're all thinking about this, because why? There's billions, trillions of dollars in this industry. I mean, I think the mortgage, if I had to guess, it'll be the mortgage industry first that figures it out, because it's the most, to me, that's the most easy, almost already standardizable because of the federal regulations. To me, that's I hate to say the low hanging fruit. But, the blockchain, everything, I think about Hugo's presentation about, with the investor side and moving assets. And, one of the things, and I'm going to say something that is, maybe it's controversial, maybe it's not, I don't know, but I would love, when we get to the very end of reactions, to get the other panelists and Jeff, everybody to react on. But, I mean, blockchain, at least as far as the cryptocurrency world, which introduced this phrase, has been plus 10 years now, correct? Right? I mean, since I think, I mean, I don't know when I first learned about Bitcoin, but I was early in learning about it. I always kind of thought it was very interesting, because I thought, as an economist, new forms of money are just cool, right? I mean, and seeing that come up, you're like, wow, this is like, and also I've always grew up as a kind of a computer tech nerd, right? And I remember friends who would trade currencies on games like World of Warcraft. I never really played that game, but I had friends in college who were, back when this very primitive architecture, but apparently they would buy and sell things in cash that then got translated to the game, right? And I understand that was part of the things that created things like not just blockchain, but Bitcoin. And here's the thing I have to say that's controversial is I think Bitcoin's success has been one of the biggest inhibitors to the actual innovation of blockchain and the adoption of cryptocurrencies in general. I mean, everyone, there's this weird sort of circular logic that whenever I listen to people talk about things such as Bitcoin, it's like, well, the whole idea of Bitcoin being, why is Bitcoin so valuable? Because it's the future, it's the economy. You're going to, all goods and services will exchange in this. So great. So you use Bitcoin to buy, pizzas or now Teslas. Well, no way would I ever sell my Bitcoin for a pizza or a Tesla, right? It's going to be worth $1 million a coin. So, well, that's it's a circular logic then, right? Because if it's not part of your economy, but the whole reason that you believe in it so much is because it's going to be every part of the economy. So there's been a love of an asset for its trading value that I think has actually inhibited some of the innovation, because I think if you look at technology, very rarely does version 1.0, like no one's running the Netscape browser, I'm guessing, right? I mean, people have advanced from things. And I feel that whenever I hear, and I'm not trying to, I don't know if Bitcoin's going to go up or down. I can't prognosticate these things at all. But when I hear people talk about investing in this, I feel like it sounds like you're going long Windows 95. And I don't think I would do that in my own stuff. So at some point, we're going to get to a point where we realize, and I think Jeff made the point, right? I mean, blockchain is not cryptocurrency, vice versa, right? I mean, one's just an application and use thereof. We are going to go these directions. I think every company, be it Skanska, be it everyone else, we're going to put money into this, right? We're not going to wait. We don't want to be found out that we got left behind. We want to be able to look at how we enter buildings. I mean, building, one of the things, and this is something really simple, building security. How do you, it used to be, right, maybe you had a key, and then now you have little cards with magnetic material. And if you didn't have one of those, you had to just queue up in line. You can kind of see in my background, the Empire State Building. That's where my office is when we're not, working from home. But, we're now in our new buildings, right? You're just going to have your phone, right? Yeah. And it'll through the QR code or through some kind of even a near field technology, when you become a guest into one of our buildings, we'll wave you right through. Well, how do we know that's actually you? I mean, there's all kinds of questions that we're looking at this stuff and saying, like, we know we have to go there and put a lot of money into it. So I think I do want to make one kind of make a few more points and then just leave the time for discussion. But I think that this last year has been a very interesting year. I'm still working from home. I'm suspecting, I can't totally tell everyone's backgrounds, but I'm suspecting I'm not the only one on this call. And I also suspect we all wish we were probably actually, physically sitting at Hofstra's campus or in at least some conference room or something other than this. I know I certainly do. I'm sick and tired of it. We've been in this zone for a while. We've all had to, I see someone commented in the chat here about they're an introvert. Yeah, I think even the introverts are ready to leave their basements, to be quite honest, but you do you. I think we're all basically experiencing something that we were kind of forced to do. We didn't really have a choice in it. And we did it, I hate to say out of fear, of good measure, right? Because I mean, how many years do you have viruses that come across that also get spread by people who maybe show no signs of illness, right? It's a perfect storm in a weird way. So the question is, when we get out of all this, are we going, are we going to run back to the way we were, or are we going to go, oh, exceed it one way? And I think the answer is a little bit of yes. My suspicion is we're all going to want to get back together really fast. I'm not worried about the future of office per se. I mean, maybe New York has some unique issues because New York's a unique city, but by and large, we just want to be together. We all want to be together. But I realized something about my own business and my own life. I'm not probably going to give up using Zoom or Teams or any of these methods, right? I mean, it's no longer going to be the distance that I would normally wait to have a meeting because I had to get on an airplane to fly to Los Angeles to meet our Los Angeles team. I'd probably wait weeks or whatever for the schedules to align. We'll call and do these virtual things so much faster. So I think if there's ever been a time when people have been willing to explore something, be it a blockchain linked investment, be it a new technology inside of a building, I think that people's willingness to try something has never been higher, because we all got forced to do something that I think probably, but for 2 weeks before that, we all had to do it. We said would never happen, or we never would want to do it, right? And yet here we are, a year later, and we've done it. And I think our company was incredibly, what's the saying? Was it incredibly successful even in this year, despite the challenges? Now, I mean, Scanscale on the construction side, which is largely, most of our projects, or a lot of our projects, were deemed essential, even in places like New York. So I mean, that certainly helps business, but capital markets didn't shut down. But I mean, we're now, internet technology, the whole idea about the single, it's funny, when I first heard that phrase, the single source of truth, I first thought, wow, does that sound like such a high-minded, almost, like religious doctrinaire comment? But like, man, you don't realize how big of a problem that actually is until you're trying to link together a couple different databases and within our properties and all these things. It's like, these are, for things that I don't even think are that hard to do. And I'm realizing, wow, this stuff is a lot harder than people realize. So I'd like to say to all the students out there that, use your open mind. This is a really interesting time. If you're wondering can you have a career in called the innovation side of real estate, in the tech side of real estate? Does that exist? I would say, yes, it exists. Those jobs that you're going to apply for are just being created. A lot of companies are just for the first time creating their first director of technology, director of innovation, right? These jobs, which, if you had told me a real estate company 10 years ago was going to have an innovation director and would be deciding how much of their capital should be diverted off to, it almost looks like venture capital activities, I'd have said, no way they're going to do it. It's all bricks and mortar, right? They're all doing it. All the big names, be it like Silverstein, RXR, Brookfield. These are, I'm thinking of some of the big Manhattan names. They've all got what you almost call venture capital arms within them, because they recognize that their buildings are going to need this and no one's really providing it. So it's a huge opportunity there. I wish I could tell you all the answers in the order of when it's going to happen. I think the other panelists are probably farther along in that, and I'm looking forward to seeing the products that come. So I'm going to, kind of yield a little bit of my time and say, Andrew, take it back. And I'm looking forward to the discussions. And I really want everyone's reactions on my Bitcoin comment before we leave the day.
Yes, thank you, Josh. And I think Bitcoin would take up natural interest and hours of discussion, but hopefully we'll get a little chat in at the end. So my pleasure following the program to introduce Alim Kamisi, who is another one of our international guests from Canada, coming in from Toronto, one of my favorite cities. We'll definitely have to meet up on Bloor Street next time I'm there. He is the executive director of the Kin Foundation, and also is sponsoring the first blockchain development program at a university in Canada. Maybe we need to do that in the US, so maybe we'll tap your expertise on that. And I'm going to turn it right over. We look forward to hearing your comments. Thank you so much.
Sounds good. Thank you so much for the introduction, Andrew. I'm just going to share my screen and make sure I can do that without any issues. Please let me know if you can see my screen here. Okay. All good with the, you can see my slides?
We can see, yep.
Perfect. Okay, so thank you once again, Andrew, for the introduction. Isam, Laura, everyone that was involved in the event, really appreciate it. The speakers so far have been wonderful. I've really enjoyed it. So my topic today, just to jump right into it, is focused on decentralized finance. And DeFi has really been something that has kind of come to the fore this year. And it's been something that's kind of been, I would say it's fairly nascent. It's been around for a couple of years, but it's really captured a lot of attention from folks in the technology community, business community, and across blockchain. So with that said, I'd like to set a little bit of background and talk about kind of the evolution of economic models as we look to the past and looking ahead. So, if we look over the last 150 years, the economic models have largely revolved around the centralized economy, which is focused on the corporate model, where employees within companies provide goods and services. The goal is to maximize shareholder value. In terms of the use of data, internet came around just a few decades ago, so low data sophistication. If we look at the kind of platform economy of today, the model is very much a marketplace model where you have employees and then you also have contributors from outside companies who are generating value for companies. Shareholder value, markets effectively generate value for shareholders and contributors and consumers. And of course, using analytics, using data is a very, very important part of business today. It offers very strategic, important advantages as it relates to operational efficiencies, targeting, better kind of targeted marketing, and getting a better return on investment on marketing efforts, and also informing strategy for organizations. I think data is used in almost every aspect of business today. As we look to the future, which I really like to think is now, and we look at the protocol economy, right? And this is where we get into really blockchain underpinning our economic infrastructure today. Blockchain offers, and I'll talk about open blockchain, which is permissionless blockchain, meaning anyone can participate. It's not private or restricted. It's a permissionless model. Any participants, and all participants are enabled and incentivized to contribute to the economy, to whatever microeconomy we're speaking about. The value is really generated by and for the community. So this is where we have network generated value, which has a focus on all contributors and users as opposed to companies and platforms. And the interesting thing here, which I'll touch on very quickly, is many of you know about the Internet of Today, right? Which is Web 2.0. The Internet of Today is largely, almost, I would say, monopolized by the big gatekeepers like the Googles and the Facebooks and the Apples, and they kind of are able to extract value from the data and that's generated from your user behavior online, whether you're surfing the web or on Facebook or whatever it may be, or across any messaging platform. So there's a lot of gatekeepers, and it's very kind of centralized again, right? The end user does not benefit from the monetization of their data. There's a really great Netflix documentary that just came out, I believe last year. It's called The Social Dilemma. If anyone has ever seen it, it's fantastic. It kind of opens up your eyes to this world of how essentially we as the end users of these free products are effectively the product. So that is very much aligned with the Web 2 kind of internet. As we look to the Web 3, which is the internet that's underpinned by decentralized blockchain infrastructure, there's this idea of data sovereignty, right? This idea where we control our data, we control who has access to it, and we decide how we want to monetize our own data as well. So think about Web3, a Facebook operating on Web3. Facebook would have to essentially, share some of the profits of monetizing our data with us as the end users. So data sovereignty is a really big one, and data really underpins everything that happens in the Web3 economy that's blockchain based. Now, the topic today is, of course, decentralized finance. And a sliver or a key vertical within the protocol economy is decentralized finance. So before I jump into that, I want to provide a little bit more background on the genesis of DeFi. So if we look at industrial era finance to today, and we look at the banking system in particular, we have this trust layer, right? Where we have financial institutions, law firms, regulatory bodies that effectively provide and broker trust for all transactions that happen in the banking system today. And then as a result of this trust layer, we also require intermediaries that are helping to facilitate that trust layer between the banking system, its end users. So, payment service providers, third-party administrators, brokers, clearinghouses, adjusters, and the list goes on. This is effectively, I like to call it, this is a rent-seeking intermediary layer. And it's needed because we need institutions and organizations to broker trust on our behalf. With decentralized finance, the idea is to disintermediate the rent-seeking layer and effectively abstract away the trust layer to software and code and the blockchain. I'm not saying that DeFi is all about getting rid of financial institutions and law firms and regulatory bodies. I think all of that is still needed, but the overhead, the burden on those institutions should be a lot less in an economy where we're able to go peer-to-peer without having to use middlemen. And so that is kind of in effect what we're trying to do with decentralized finance. What is DeFi? Okay, so DeFi is a system without a central governing authority, and it's fully open to anyone around the world. Again, it's permissionless. It sits at the intersection of financial products and services with decentralized networks and open protocols. So think about all the financial products and services we have today in the traditional finance world. Effectively, we would have all of that and more built on blockchain infrastructure. So DeFi startups today, as I mentioned in the previous slide, are working to kind of strip away the centralized parties in financial services using decentralized protocols. And what we mean by decentralized protocols is effectively, these applications built on top of open blockchain. Ethereum is probably one that many of you have heard of. It's number 2 next to Bitcoin. But it is a programmable blockchain that allows for all of this interesting, all these interesting applications and use cases to be built on top. And DeFi is, I say could, but it is radically changing the way that we are going to interact with the global financial system. So to summarize, if we think about the core DeFi innovation, it's 3 things here. So 1, the trust layer is now abstracted away into software and code. This eliminates the time and cost of intermediation, meaning, we have much more efficiencies that can be gained as a result of going peer-to-peer and using blockchain infrastructure. And Hugo has also talked about some of the efficiencies we can get from using blockchain infrastructure in across the world of finance and real estate. And then the other benefit is we enable programmable money, real-time risk transfer, auditability of financial contracts, which isn't really possible in the traditional context, as it again in the context of like efficient financial services, efficient, fast, and trustless, and almost peer-to-peer. So there are implications for decentralized finance in both the developing and emerging markets. In the developed world, DeFi is going to provide greater consumer choice. It's going to strip away the costs of the legacy financial system. And Hugo talked about some of this again. And it's going to bring greater liquidity and product innovation to capital markets. And if I try to relate this again to real estate, if we look at real estate, as Hugo mentioned, highly illiquid assets, if we're able to fractionalize those assets, tokenize those assets, and make them tradable across open blockchain infrastructure, we've now increased the liquidity and we've lowered the barriers to entry for investors to get into those asset classes. So there's huge benefits there. If we look at emerging markets, I think the impact is going to be much more pronounced. DeFi will have, is going to unlock basic financial services to the 1.7 billion adults who lack any access to a formal financial system. So, if we take Africa, for example, right, many rural communities that don't have any bank branches or any access to financial services or, with a physical presence, they are using their cell phones for everything, right? They're using their cell phones, in fact, as currency. Airtime credits in many parts of Africa are considered a currency. Now, imagine if that cell phone, it's got an internet connection. That's all you need to access the world of decentralized finance. And all of a sudden, all sorts of financial services are opened up to those individuals who previously were unbanked. So DeFi is also about open access for anyone, and to lower the barriers of entry again, and the overhead of getting into just basic financial services. So, if we look at the first use case of DeFi, this might come as a surprise, but it's really Bitcoin. Programmable money, that is effectively, many consider it to be a store of value or a medium of exchange. It is very much disrupting the remittance market, right? I mean, you can send a transaction for much cheaper. The cost might be negligible versus looking at a Western Union transaction or a bank wire transfer. And it's a $715 billion remittance market. That's based on the World Bank 2019 estimate. But this is really the first kind of beachhead of DeFi. And then if we look forward into the more complex world of financial products and services built on top of open, permissionless blockchains like Ethereum, and I don't want you to get lost in this map. This is a lot to take in, but all I want you to take a look at here is the categories, right? So we have, DeFi is really boundless in terms of the different asset classes, the different types of financial products and services that that kind of fall within its fold. Asset management, prediction markets, marketplaces, lending, borrowing, asset tokenization, exchanges, staking, stable coins, decentralized insurance, derivatives. The list goes on. There are many different specific areas within the DeFi landscape. And the idea here is just to show you that peer-to-peer open financial services are possible on blockchain technology. We can have everything that we have in the traditional financial world plus more, because DeFi really unlocks entirely new business models that are based on tokens, and entirely new governance models as well that weren't possible in the traditional financial world. And an important thing is I wanted to touch on was exchanges. So just the third column here to the right, you'll see, this is full of decentralized exchanges. So if you think about the New York Stock Exchange or the NASDAQ today, these are centralized entities, that are regulated, that operate, these exchanges on behalf of their users, on behalf of the market. But they control everything, right? Everything is controlled in a centralized manner. Decentralized exchanges allow you to swap or trade tokens in a more peer-to-peer fashion without a centralized entity. And then you might be asking, okay, who governs and who manages these centralized, these decentralized exchange platforms? Well, it's the community, right? And the community, if they hold tokens related to that exchange, these are governance tokens, which allow them to vote and to vote on upgrades or important governance decisions around those platforms. So decentralized exchanges have really popped up over the last couple of years and have started to gain a lot of traction. Here's an example of the type of traction one of the world's biggest decentralized exchanges has garnered over just the last year. So Uniswap, again, is a DEX that's built on top of Ethereum, the Ethereum blockchain. And in January of 2020, the total volume transacted on Uniswap was about $500 million a month. That's since grown in just the over the last year to over $12 billion a month in transaction volume. So it's very significant. And DEXs like Uniswap are some of the key, almost I call them DeFi primitives that underpin the entire DeFi sector. Wanted to quickly touch on, again, just the DeFi space in totality in terms of the total value that is locked within these protocols. And first, I'll point you to the chart on the right-hand side. If we look at the category column, we can see lending, DEXs, derivatives, and there's many others, as I showed you in the DeFi map previously. These protocols that are built on top of Ethereum collectively have over $56 billion of value locked within the smart contracts on those protocols. And the value is effectively Ethereum, like ETH, as well as other types of tokens that are locked into these smart contracts. And you might be asking, why would people want to lock tokens into these smart contracts, for these decentralized finance products and services? Well, it's to earn a yield, right? They're doing it to earn a return. And I will get into that shortly. But again, you can see that from just May of last year to April of this year, the DeFi space has really exploded. It's gone exponential. It's exploded, and there's been a ton of value in the form of tokens, locked into these protocols. So, how would someone earn a yield in DeFi? Well, there are two main ways, and there are many others, but liquidity pools and yield farming. And I don't want to get into too much of the complexity. I just want to kind of give you a quick primer on what these are and why they're so important to DeFi. Liquidity pools, in essence, are basically pools of tokens that are locked into a smart contract, and they basically help to facilitate trading by providing liquidity to the decentralized exchanges. These decentralized exchanges require liquidity to operate efficiently. And so when people effectively take their tokens, they can lock it into the smart contracts, effectively like staking it. And they earn a yield on their tokens that are locked. Yield farming is another way that folks can earn a return on their tokens. They basically stake their tokens, or they lend their tokens on these platforms. Like Compound is one of the bigger ones that does borrowing and lending and yield farming and all sorts of interesting things in the DeFi space. And they effectively allow the user to earn a return. In a very highly simplified view, the liquidity and staking incentives, the annual percentage yield that's offered by these platforms to users that want to stake or lock in their tokens in their smart contracts, drives the total value locked up. And that effectively drives the valuation of those platforms up, which increases, again, the incentives that the platform offers, which effectively is kind of like a virtuous cycle. So this virtuous cycle has truly created, billions in volume, locked assets, and valuation. The yield that's being offered today is probably not going to be the yield that's going to be offered in the coming years. I mean, it's very, very high today. You can earn in excess of 10, 20, 30%. But that will eventually normalize, because of course that's not sustainable in the long run. I'm almost done. I know I'm a couple of minutes over time, but I'm just going to wrap it up very quickly. In terms of the revenue that's being generated by DeFi platforms today, you can see it's in excess of $200 million per month. And decentralized exchanges like Uniswap, SushiSwap, lending and borrowing platforms like Compound Finance, Aave. These are all some of the biggest platforms in the DeFi space where, that are generating this significant amount of revenue. And that revenue is really being shared by the community of token holders who effectively collectively own these platforms. And it's also provided to folks that are staking and locking in their assets onto these platforms. Last slide. So we know that Coinbase went public today on the NASDAQ, and Coinbase is an example of a centralized exchange for exchanging crypto assets, but they also offer a wallet. They have enterprise and institutional grade custody solutions and so on and so forth. Coinbase also announced, just recently that they are joining the DeFi Alliance. And I think what we're going to start to see, this is a trend that's starting, is the connection of the centralized financial world, the traditional financial world, as we call CeFi, to the world of DeFi. And Coinbase and others are going to be on-ramps. They're going to be on-ramping fiat and other value into the DeFi world in a more regulated way. So look out for that trend in the coming months and years. That's going to be something that's going to really be big. And that's it. I'm going to end it there. I know I'm a few minutes over. Apologies. But I imagine we don't have time for questions. So Andrew, back to you.
Thank you for that very informative presentation. We'll try and have some questions at the end. Clearly, this has the potential, if not on the way there already, to being life-changing for many people. No question about it. Sort of what the internet was, this is going to be very similar for finance and so on. But we're going to turn over to our last speaker, Joel Simpkins. Joel is a Hofstra graduate, a proud alumni, and we're always glad to have alumni back on the panel. Joel is head of gaming and leisure investment banking at Truist Securities for 5 years now and has a long history. You were not in my class, but I'm looking forward to learning from you now, Joel. Thank you so much for participating.
Well, hey, great to be here with everybody this afternoon. And this has been very interesting to hear lots of different perspectives, certainly from folks across different industries that I would typically run into on a day-to-day basis. So quite informative. And I'd say my head hurts a little bit because this is some really high-level thinking. But in all seriousness, as Andrew mentioned, I graduated from Hofstra in 1998. I've had a 23-year career on Wall Street, first as a research analyst on the debt and equity sides, across a number of bulge bracket investment firms, spent a few years at a hedge fund. And then more recently, I came over to the investment banking side from research about 5 years ago to start up the gaming and leisure investment banking practice at what was SunTrust and now is Truist, which represents the merger of BB&T and SunTrust. We're about an 85 billion market cap bank. And I believe as of the last couple of weeks, we're probably the 5th largest bank in the US from a deposits perspective. So in my role, I'm really at sort of the crossroads of capital, whether it's from a debt capital markets perspective, helping companies raise debt to finance transactions, equity, taking companies public with IPOs, SPACs, et cetera. And then also, more importantly, on the merger and acquisition side, putting companies together. So I don't know if it's up or you can display it, Andrew, but I did provide Professor Nick Bacht a copy of a report I actually authored literally a year ago and a day about this time in April when every casino in the United States was closed, which I could have never imagined in my career. So I thought this would be an interesting piece to share with folks, and obviously, while maybe not a chance to read it right now, after the presentation, this evening, particularly for the students, I think it would be a great read. So I remember writing that piece from my son's bedroom. I was living in Hoboken at the time, and we were pretty cramped on space, and my son's bedroom became my office. And I was thinking about, my 20 plus years around the sector and how it was going to be, invariably changed from here on out because of COVID. And, I try to think about, and again, I used to be a research analyst, so I used to write lots of these reports. So I dusted off my writing skills and big picture thinking. And it's pretty fun and interesting to look back at this piece. And I was really kind of winging it last year and saying, okay, this is what's going to happen. And hopefully, if I'm right on half of these things, then I guess my crystal ball was prophetic. But I think in the context of today's conversation, really on first on technology and how it's changing, not just my industry but my personal career. I thought this would be helpful to run through a couple of big picture takeaways. So I guess, starting from the kind of top here, I think, bottom line is technology has changed the way I do business as an investment banker, probably for the foreseeable future. And so, when I think about my life before COVID, I spent about 100+ days a year on the road, visiting with clients in Las Vegas, many other places where there are casinos and resorts, pitching for business, doing sort of that, flying, across the country or flying out even to Chicago for the day for, what was a 2-hour meeting with a CEO or CFO. And, I'd say maybe it would have been a sort of a lower probability outcome of generating revenue or business. Fast forward to where we're at today, I think once we sort of come out of this and things return to quote unquote normalcy, I think I'm going to be traveling, perhaps maximum 30 to 40 days a year in the 30 to 40 days a year to visit clients, and those conversations are going to be highly targeted. They're going to be potentially to celebrate a transaction or maybe close a very important negotiation. And as I think about that from a hospitality perspective, I think that's going to invariably change, the real estate industry, particularly, business travel. And I think, while not the focus of today's conversation, the lodging industry is going to go through a tremendous amount of change, particularly those that are very reliant upon convention business and sort of that road warrior that has to be out on the road or had to be out on the road historically, and now can accomplish a lot of the more mundane, basic conversations through a Zoom call or WebEx. And, I'd say one example of this where, Truist is very much a North American centric bank and investment bank. Although, interestingly enough, in November, we took a company public called Neo Games. They're traded on the NASDAQ. They're about 800 million market cap company at this point. And they're actually based in Israel. And, this is a company where I've actually never met the CEO or CFO. And, with 20+ years of experience in the industry and knowing a lot of folks, I was given a warm introduction to the CEO probably last, August or September, had 3 or 4 Zoom calls with them, talked about our ability to be helpful and to participate in the transaction and play a meaningful role. And next thing you know, we're a book runner and generating, roughly 15% economics in their IPO, and what's been a huge success. So if I think about the old days, the old way of doing business, if I was going to be doing business in Israel, I would have to flown out there, been extremely tired, and really have to bring my A game for what would have been maybe a 1 or 2 hour meeting, and then get back on a plane and fly home and hope it worked for the best. So Zoom and WebEx and all these technologies have made my life a lot easier, been much more efficient, and allowed me to really multitask and ultimately drive a lot more business for my investment bank, because my time isn't chewed up living on an airplane, and I can knock out that call and be on to the next 4, 5, 6, or 7 calls of the day. And I think this trend is here with us to stay. I was even on the call yesterday with a UK company, similarly having a conversation about taking them public sometime this summer, where they're looking for our help on the transaction, and we were able to get down to brass tacks. And what might have been normally a 2-hour meeting face to face was a 30-minute conversation, and we're already turning NDAs and working on the transaction with them at this point. So very quick and efficient. A couple of things I wanted to talk about, particularly from a technology perspective. And again, this is probably a little bit more practical. and less theoretical. But as I mentioned before, I've been around the gaming industry for over 20 plus years. And when we think about the gaming industry, or you think about the casinos in Las Vegas, you think about the regional casinos that some of us are familiar with and are probably driven by over the years. And I would say I've probably seen more innovation in this sector in the last year than in that 20 plus years of existence. A lot of that has to do with something I talked about in that report, and that was the rapid convergence and adoption of sports betting and online gaming. So I'm sure anyone here on this call that turns on the television, particularly maybe around a sporting event or even the nightly news, you're going to see an advertisement for DraftKings or FanDuel or some sort of sports betting product. And what's happening right now is more states are legalizing this. New York State just approved mobile sports betting last week, and you'll see that implemented probably in the next 6 months or so. And just about every other state across the country, given state budget deficits, is going to be looking at sports betting and online gaming as a potential solution for budget gaps. As a result, this is creating a lot of convergence between bricks and mortar gaming, sports betting, and online gaming, and the technology, that powers these businesses. So if you're someone that goes to a physical casino in Las Vegas, let's say the MGM casino, you might have the MGM app in New Jersey or eventually New York State, and they're going to be able to see, what type of player you are in the bricks environment, what type of player you are online, and be able to market and tailor different incentives for you to play and, garner your customer loyalty. I think one interesting trend within this technology and gaming landscape that's pretty interesting from my perspective, and certainly changing how I do business and who I do business with, is traditionally, gaming has been very much a real estate capital intensive business where, I'm dealing with real estate investment trusts and other typical, real estate investors today. With all that's going on in my space, particularly around the sports betting online gaming side, there's been tremendous convergence with my legacy sector and now the media industry. So a lot of my time now is partnering up with our media investment banking team and speaking to sports team owners, to cable companies, to content providers, and figuring out how we can help them evaluate the sector, make potential strategic investments, form partnerships that ultimately, allow them to capitalize on what's a significant, amount of growth and opportunity. So one real world example of this is our media investment bankers work closely with a company called Sinclair Broadcasting. They own a number of cable stations around the country and regional sports networks. They recently partnered up and made an investment in one of my clients called Bally Gaming. Bally was a historical large operator of regional casinos. They're going through a rapid business transformation and pivoting into online gaming and sports betting. And just yesterday, they announced two significant merger transactions. They're actually acquiring a UK sports betting and online gaming company. And we've been in the middle of those transactions over the last few weeks, making sure they can prepare to finance that through debt and equity. Another area that I think is quite interesting is, again, on this theme around technology and how it's changing bricks and mortar, everywhere you go, we've worked closely historically with lottery companies, right? Those that, if you walk into a 7-Eleven, you purchase a physical lottery ticket or a scratch off. And that's obviously a huge traffic driver, not just folks going to pump gas, but maybe walking into a convenience store, buying a soda or a cup of coffee, maybe a lottery ticket. That industry and the convenience store business is probably going to change substantially over the next few years, not just because of the impact from gasoline powered cars to electric cars, but, for instance, we're working closely with a company called Jackpocket, and they basically enable you to use your iPhone or your mobile device in that Internet of Things context we were talking about earlier, to purchase a lottery ticket directly on your phone, be able to pull it up and actually see a digital rendering of a physical lottery ticket that you're able to purchase. And this technology is only up and running in about a half a dozen states right now, and I suspect that over the next year or two, as states welcome this as a new source of revenue, that you're going to see Jackpocket and other similar companies, deploy this technology, and it's going to become quite mainstream. On one hand, you're going to get pushback from the folks that own those convenience stores. On the other hand, states and folks that stand to generate from this tax revenue are going to see this as an opportunity to target customers, that may not typically buy a lottery ticket. And I'll admit, I am not much of a gambler, but occasionally you see that change your life. Jackpocket, some sort of huge jackpocket around $500 million. You say, what, I want to buy a lottery ticket. And I've even used Jackpocket on my own to buy a lottery ticket over the last couple of years because it's just fun and entertaining. Earlier, one of our presenters was talking about AI and machine learning. And this is technology, and again, sort of well above my level of understanding. But we're working with a company right now called SimpleBet, and right now they are operational with FanDuel and DraftKings and a few other players, really on a free-to-play basis right now. But these guys have developed pretty interesting technology that will essentially allow you to bet on every single pitch of a baseball game or every snap of a football on an NFL game. And those odds pricing the odds and the pricing around every single pitch or snap of a football change real time, dynamically, and integrate not just historical stats, but real time stats into that odds making. So think of it as almost short term options trading. And this is something that I'd say is probably a year or two away from becoming mainstream and adoption, but it's technology that you're going to see roll out over the next couple of years that, again, incorporates AI and advanced machine learning. And then finally, it's one of these things where I wrote about it in the report provided, where, and I think somebody made a comment earlier about their industry, maybe the real estate industry being 20 years behind the real world. And I would say that certainly applies to the gaming industry. The gaming industry, given that it's highly regulated, typically tends to be, let's say, about at least a decade behind the mainstream. And when I authored this report about a year ago, I talked about the future of cashless payments in the casino and how that is something that could certainly take hold, because at the end of the day, money is dirty and consumers don't really want to engage with it. And obviously, most of us are either walking around with a smartphone, and on that smartphone, we've got Venmo or Zelle or some other sort of payments mechanism where, we don't have to pull out our credit card anymore. We don't have to pull out cash. And I think we're finally on the precipice of seeing mainstream adoption of cashless in the casino context. And we're working pretty closely with a number of these companies right now. One's called Acres Gaming. Another one is called Sightline Payments. And basically, these companies are working very closely with casino regulators as well as operators to allow, and you'll probably see this roll out in the next 6 months at a handful of casinos, to allow you to pull out your smartphone, create a house, a banked account where you sort of pre-fund your wallet of what you're going to spend, pull out your phone, hold it up to a slot machine, fund, or even walk up to a table game, same thing, and fund your bets. And obviously, hopefully if you win, the funds will be credited right back to your account. So operators love this because it's going to increase the velocity of play. It also will have to reduce the amount of cash they have to keep on hand. Consumers like it because it's going to be highly convenient and really what they're accustomed to. And then more importantly, regulators and other constituents, particularly that are focused on compliance and AML and other concerns that are commonplace in a casino, are going to be able to monitor all that activity. And I'm not saying there's going to be 100% adoption of this, but I think it's going to, you're going to see this roll out significantly across the industry over the next couple of years. And maybe one final soundbite, and I think I'm relatively on time here. I think Josh mentioned it earlier in his comments, and I think given that we have all these students on the line, I would certainly echo his comment and advise students that, as you're thinking about your career, if you're a junior or senior, you really want to be thinking about these next generation growth areas where the future job opportunities are going to exist. And I know that's certainly, easier said than done. But, I think some of the things we've been talking about today should give you a sense of, the future of finance, the future of technology, and how that's going to drive a lot of these legacy businesses going forward. And I'm in my mid 40s. I graduated, like I said, in 1998. So I've seen a lot of change in those 23 years post Hofstra. But a lot of the folks that I'm dealing with, particularly in some of the businesses I talked about earlier, are people in their 20s and 30s who saw a really interesting opportunity, saw the potential to disrupt some of these businesses, and they are enjoying a tremendous amount of growth and are right in the middle of a lot of hiring and change that's probably going to power these industries for the next couple of decades. So I'll stop there, and hopefully that was informative.
Well, that was great. Thank you so much, Joel. And we do have a few minutes to take some questions, but I did first, want to make sure I thank all our panelists for I'd say traveling in, but taking the time, preparing. It's not easy, and we really thank you for your insight. But I want to give the panelists first a chance, if they want to respond to anything they saw on the panel, they get the right of refusal to comment first. Anything, Hugo, Alim?
No, I think we all agree in the main idea that these are technologies that are up and coming. These are here to stay. It's not a fad. And if your students are able to get in early, you're going to be able to benefit from these technologies the most.
Yeah, I echo that as well. And I'll just say that it's interesting to see kind of where technologies are converging with trends and kind of where there's a pull in the market, and I think Joel, you talked about gaming and the kind of convergence with blockchain and the emergence of NFTs, non-fungible tokens that we're seeing, and cross-game assets. That's truly going to be something that's huge and transformative over the coming years. So to look for those convergence opportunities. Yeah.
I do want to respond something to Joel said. Actually, maybe I'll to use the pun, I'll take the opposite side of the bet. That's on the business travel market, or just certainly travel market, but even the business travel. I think that all this interconnectivity and that we're doing, while Joel may not travel as many days and I might not travel as many days in total, I think on net, I know at our company we have more cross-market, cross-functional teams we've ever had doing these LDTs, because hey, we could all get all these cameras. I would be shocked. In fact, I'm running the business plan process that we will have more and more of that, and inevitably when you can travel, you're going to travel. So I've heard the prediction before about, oh, we have technology now, so we won't travel. And every single time, be it from Facebook, be it from actually, I think it was AT&T or Julie with the whole video call thing back in the 90s, it has always resulted in record amounts of business travel and more reasons to go to conferences, because let's be honest, it's really no fun doing a happy hour on a Zoom call, right? I mean, you could still get drunk, but it is not the same experience. So Joel, I'm going to take the opposite side of that bet. Now, you may not travel as much, but
I didn't really get a chance to sort of form the full mosaic there. And I hear you. I think, I'm certainly, again, I was a research analyst for a long time, and I covered Hilton and Marriott and Starwood and all the major players. So I'm certainly not predicting the death of business travel, because you're right. Seeing clients and face-to-face, having that drink, having a side conversation with somebody, picking up on body language, you certainly can't replace that. I just think for the next few years, it's going to be a little bit rocky and a bit choppy on the velocity. But you're right, team builders are going to be important. I miss a lot of my colleagues on my team that we have a few. We're primarily in Charlotte, North Carolina, and Charlotte and Atlanta. But a fair amount of my team's in New York. I've been able to catch up with those folks in person. But, my vice president, who works his tail off and is a huge part of my team, I've been seeing him since, January of 2020. And I really do miss spending time and grabbing a beer and chit-chatting. So, I'm going to be on the first flight to Atlanta as soon as I can get down there in the next month or so, hopefully. But you're right. You can't replace that face-to-face interaction internally and externally.
Yeah, and I would add, I actually might, if you really want to, I'll call it even a prediction. I think that the more you can do virtually, the more you create actually more reasons to travel, because I mean, and that's something I think in technology in general, people, I think it's always a mistake if you think technology is truly a replacement, right? It actually creates more reasons to do things. And that's always been the experience. So, you know, it's when you're crafting your pitch decks or whatever it is for your product, you know, be mindful of making wild expectations sometimes, because it can be 180 degrees different, often in a good way. But
That's great. I just feel like I want to make one comment, and we'll just take maybe another question or two. This is wonderful. So I remember when folks said cars are going to be so much more efficient, and we're going to go to hybrid cars, that there's going to be less demand for gasoline. Actually, I think what we found was the opposite, that by creating this efficiency, it allowed people to drive greater distances and live further from, you know, their workplace. Now this tremendous amount of technology, maybe there won't be as much business travel, but now think about this. You can now fly to Key West and you can be working, but you've traveled. I don't know if that's business travel or that's leisure or that's both. And I guess the IRS is probably going to have to try and figure this out as well. But there's going to be all of these tangents involved. And this is just one part of the technological change. You know, I just want to turn it back to Jeff for a second as kind of the kickoff speaker here. If you have any thoughts on a wider perspective, and if there's any questions, try and chat them to me privately or chat them so we can get them answered quickly.
Yeah, thanks, Andrew. I think it was interesting. I saw a lot of tie-ins between some of the things I touched on, and I love the expansion by the finance experts. I don't actually have an MBA or anything other than the economics classes that were pushed as a distribution major when I was an undergrad. So this is that's one of the reasons I had told the organizers I was going to stay the whole 2 hours, because I knew it would be a learning opportunity. And this is it's just interesting to see in depth how all these things are being applied. So I appreciate that.
We'll give you one last chance for some questions, or Asan, do you have any questions, or head close to wrapping up?
No, I would like to thank all the participants, Jeff, Hugo, Alim, Josh, Joel. We'll invite you back. I really enjoyed it. I'm sure our students enjoyed it. But let me acknowledge the fact that if it was not the efforts coordination of Laura Fetter and Judith Black, we would not be here. Thank you all. You worked very hard, and I'm glad you all enjoyed it. And with your permission, everybody's permission, that will conclude the session today. Thank you very much.